Welcome traders. New traders are often confused by the numerous choices they have about which time frame they should be taking trades on and looking for opportunities on. As you may or may not know, this video is part of a series of videos and I have already discussed the differences between technical analysis and fundamental analysis and the difference between day trading and swing trading. Again, it's worthwhile reminding you that although there aren't an unlimited number of ways to engage in the financial markets, we certainly do have several choices available to us. Sometimes we only have certain hours or a certain amount of time available for us to look for opportunities in the markets. We're limited by that, and at other times we have too much free time. We could sit in front of the computer all day long. Both of these have their pros and their cons, and both of them are sometimes more appealing to some of us than to others. Of course, you could be forgiven if you don't know which will suit you and which type of trading personality you may have at the outset. Not only that, but we might change our style over time as we grow and learn as traders. For traders who only have a fixed amount of time available each day, it may make more sense to look for opportunities on the higher time frames, such as the 4-hour, daily, or weekly charts. These time frames allow the traders to not have to be in front of the charts every minute of the day. This is ideal for individuals who may want to look at the markets before they go to bed or first thing in the morning before they head off to work. It is particularly beneficial when the amount of time per day for trading is 30 minutes or less. Conversely, some traders may have more flexibility in their schedule, which would allow them 2 to 4 hours per day uninterrupted in front of the charts. And in these cases, looking for trading opportunities below the 1-hour time frame, even as low as the 1-minute time frame, could turn out to be the best choice for them. As a third option, there is a sort of in-between hybrid version where if we're monitoring the 1-hour time frame, for example, we may be able to check it every 55 minutes to see if a setup has occurred. And in between those 55 minutes, we can spend the rest of that time doing something else that may not even be trading related. So how do you know which one is right for you in the beginning? You don't. You need to look at your available time, your daily routine. Most importantly, what are your non-trading commitments that you need to work around? This will help you to decide how much flexibility you have on any given day. In order for us to be consistent with our results in the markets, we also need to be consistent in our own behaviors and routines. Another factor that we need to be aware of, and it is crucial to understand, is that as we drop down to the lower time frames, especially as we drop below the 1-hour time frame, the markets begin to move a lot faster. They're also more volatile and they're prone to random spikes, and that can increase our number of losing trades. The faster moving markets do allow us to enter and exit the markets in a shorter period of time. But the speed of the markets and the increased volatility can be very stressful and sometimes confusing for traders who are not accustomed to this increased pace. The beauty of trading on the 4-hour, daily and weekly charts is that the markets are moving a lot slower, which allows the trader more time to qualify their trade setup and usually not as prone to price spikes as a result of either a news announcement or just random behavior. Newer traders should feel free to experiment and try different timeframes as long as it supports their strategy and their lifestyle availability. For me, personally, since quarantine, I've rediscovered the joy of early morning day trading. My day usually begins in front of my computer at 6 a.m. and often by 9 a.m. I'm finished taking trades. However, when I'm away on holiday, I might change my routine a bit so that at 10 p.m. UK time, I have a quick scan through the markets to see if there are any setups on the daily charts. And if there are, I place my orders, and if there aren't, I don't. This means that while I'm on holiday, my time in front of the charts is reduced significantly, which allows me to relax and enjoy my break. What is most important to remember is that we should not feel forced or pressured to place trades that we haven't had enough time to qualify. The market is in constant motion, and sometimes the setups just aren't there. When you hear about traders needing to sit on their hands as a way to not make mistakes, this is specifically referring to when the market is not providing setups, and yet the trader feels obligated to do something with their time in order to feel useful. If you're serious about trading and you want to learn more, then get in touch with me on my ambassadors homepage at FXGlobe.